Ever wondered what really affects mortgage interest rates, rising or falling? So today we have Rhonda Johnson with Cornerstone Home Lending joining us today, and she's the only certified mortgage planning specialist in the state of Alaska. So when I have questions like this, I go to the person with all the information. So, hey, Rhonda, how are you today?
Hey Melissa, doing excellent. Look how sunny you look.
Well, because today I'm outside in my backyard. So you probably hear a few dogs barking, possibly because my neighbors across the way, well, their dogs, I think they only let them outside once or twice a day and they just bark, 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 bark because they're not outside dogs, poor little dogs. So, Rhonda, you want to share with our viewers that might be watching us for the first time, how long have you been in the mortgage industry?
Yeah, so I've been doing this since 1983, just had my 39th anniversary in the industry, and I know we've been working an awful long time, so you've been doing this for quite a while too.
Yes, I have been doing this quite a while, and I have seen, and I started when interest rates were here. Then
Yeah.
they went down, then they went back up a little bit, then they went down, and then they went down some more. And now they're kind of correcting. So when I'm working, I did an open house this last weekend and met with quite a few buyers who just were tired. And they came in and I said, so how long have you been shopping? What's been going on? How's the home search going? And they're tired and they're not understanding why, if we're in this crisis of inflation, why would we raise interest rates? So I didn't have the answer. So I think it's great for our conversation today to talk about what really does affect mortgage interest rates and why. Why did they go up? Why?
Yeah, you got it. So first of all, Melissa, let's just take a little look here at history if you don't mind. And so I hope you can see this okay, but basically, last year in 2021, we were hanging out right around the 3% range on average for interest rates. And if we go back a decade, just to 2011, then we were at about the mid fours. And so that was still really historically low interest rates. The decade before that, we were right near 7% at 6.97 on average. So that's really kind of more the norm on the interest rates as those sixes and sevens. That's where we've been at for a full decade until recently. Prior to that, then here's where you're hearing those historically high interest rates in the nines and tens back in the 90s. And then back in the 80s in those double digits of 16, 18, 20% interest rates. So where
Now
we're
I
at
have
right,
sellers.
pardon me?
I have sellers right now who've owned their homes 30 plus 30,
Yeah,
40 years. And they're like, oh, honey, back in the day, I got my interest rate and it was 14.5%. And
yep,
so they're cracking up when they're like, well, I don't understand why buyers are freaked out by the 6 something percent.
yeah.
So I can see here by this chart really well that really over the last 10 years,
Uh-huh.
buyers have not seen things over 4.5%. So they are going, hey, we've been in
Uh-oh.
the market 10 years. What happened?
Exactly. You're exactly right. You're exactly right. So what makes these things move? I mean, there's so much information out there, right, that it's a little bit confusing. You hear the Fed's increasing them, but does that really affect the long-term rates? And what really makes these interest rates move? And what makes them go up and down? Is it just greedy banks wanting more money, or is it what? Well, and the first thing that I have to clarify is that it doesn't matter which lender you use, that lender is not loaning the money. That lender is the go between you, the home buyer, and the investor that's actually loaning that money. So you can't go knock on FHA's door and say, hey, I want a mortgage loan and buy a house. They're going to say, go to a lender who will coordinate all of that.
I
So,
often get that question with Alaska Housing because a lot of people think, well, can I just call Alaska Housing Finance Corp and get a loan? And I say, well, no, they're just a servicer. They just provide the funds.
correct.
Those funds have to be given to you by a licensed local mortgage loan officer.
Correct. You're correct. Yeah, absolutely. And so we're that go between, we're the door you knock on to go shopping all those different investors, depending on the loan type that you need, and that's going to work out best for you. then we're the ones that go find that right product for you, and we negotiate that loan between you and that investor. So really, the lenders, the banks, the mortgage companies don't have a thing to do with those interest rates. It's
Hmm.
the investor that's loaning the money that sets those interest rates. And they determine that based on what's going on in that market. Now, we hear a lot about the feds making changes to the interest rates, but you have to remember that that's really the short-term money that those investors, the banks, that kind of thing are borrowing from the government or wherever. And so when the government says we're increasing the rates, that's the money that they're loaning out to the banks on things like home equity lines of credits, credit cards, car loans, short-term loans, but really not the big long mortgage loans. So people get that misconception an awful lot. And the reason why they increase those rates is to fight inflation. So when inflation starts getting out of control, it costs us tomorrow 20 cents more for that same gallon of gas that we could have got today for no apparent reason. If we're loaning out money for 30 years at yesterday's rate and then it goes up, we've just lost that much money, right? So they're trying to bring this inflation down so our money today is still worth the same tomorrow. And so we get our mortgage money, the long-term mortgage money, from the bond market. So you've heard a lot of people talk about, I have money in a 401k or an investment or an IRA. Well, that's all kind of long-term investments. It's usually, I'm going to put part of it in this nice, safe, long-term bond market, excuse me, or the more volatile stock market and try to capture gains faster, but you also risk losing it faster. So there's a combination. We're talking people that have big retirement accounts. We're talking the State of Alaska Permanent Fund plays this game. We're talking Merrill Lynch and Edward Jones and all of the big money managers are playing this game. Do I put this money in the stock market or the bond market? Since we get our money from the bond market, when there's a big supply in the bond market, they can loan it out at a lesser rate because there's a whole bunch of it to invest. When that supply diminishes, the rate goes up, just like when we ran out of toilet paper during the pandemic, you were paying a fortune because there wasn't a very big supply, right? Well, so when the supply of the money goes down, the rates goes up because the demand is still there, but there's not very much supply. So what we're looking at is the bond charts. And what this shows, each one of these marks, these red and green marks, is called a candlestick. And it represents the movement of one day in the bond market. So this is all of these fund managers putting money in or taking it out of the bond market and either putting it in or out of the stock market. So there's playing this game every day, all day long. That's why the rates move all day long, depending on.
And so this is in correlation with the fact that rates did go up significantly around the 8th through the 16th because we have more red candlesticks than we do green, which means there was less money in the bond market to be loaned. And so that is why we had that pretty dramatic week of really, oh my gosh, wait a minute, I love my house, but you're telling me I have to now pay an extra $600 a month?
Correct.
Wow.
And that happened overnight from Thursday to Monday.
Yes.
It fell, it was like a waterfall over the edge of the cliff. The rates, the bond market went down, and overnight those rates went up.
I like the green.
Yeah, we do too, believe me. So we're trying to gain back just a little bit of what we lost, but you can see that we're still nowhere near where we were just last week. So each one of these represents the day's movement. So this one started off down here, and it went all the way up here and went back down just a little bit. So the thin line kind of tells you the market movement that day, and then kind of where it ended up. Now let's go back just a little bit more, okay? So remember, each one of these ticks, each one of these candlesticks is one day's movement. So this is just the most recent month. So if we go back maybe 6 months, then you'll kind of see that waterfall effect happen right here. And you'll see
Yep.
where
It just
it,
went. And that's what people called it. Oh my God, what happened? It was everybody was going, oh my gosh. Loan originators were almost crying because
yes,
again, people needed to lock, but they weren't going to lock them because
yeah.
they're, and then what do you do? Because how far is it going to go off the cliff, right? There's no crystal
Exactly.
ball.
Exactly. It's easy to look back at it now and say,
Yes.
okay, we're trying to come back up now. But when you're in that free fall like that, who knows what tomorrow's rate's going to look like? So it was a big question. Nobody has that crystal ball. That wall was up there. We couldn't see what the future was going to look like. So that question mark is there. So it's not big, bad, mean lenders or anything trying to jerk
Mhm.
you around. It's we don't know what the candlesticks are going to look like tomorrow until, we see what's happening here. So you can see it's really evident there where that big fall was and what happened overnight. And that's what created this panic overnight because Friday you qualified for 250,000
Mhm.
and Monday you qualified for 225,000.
Yep.
And when you found that $250,000 house over the weekend that you wanted to write an offer on, I could not say you qualified anymore on
Yep.
Monday. And it
Had that
was
happen.
devastating and hurtful and a lot of work on a lot of people's parts that didn't come true on Monday. So that was really hard. But the other reason why this kind of panic, let's go back even a little bit farther. And you can see where for these last couple of years we just kind of floated along, floated along, floated along, very steady and stable. And then these rates started going up, 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 and then we fell off that cliff over here. And so that is why everybody's been, oh yeah, the rates are in the threes. We're good. We're good. We're good. We're good. We're good. Whoa, we're at six. What happened?
Right.
And this is why. This is what the market is doing. So that's the real kind of simplistic way to look at it. When there's a lot of money in the bond market, then we see the rates go on sale. When the supply of the bond market goes down, those rates are going to go up. And really, we're just getting into more normal territory than where we've been for the last decade, basically.
Yes, I think that's true. And what we're finding is we're going and meeting with clients and sellers and talking about what does the market look like. We're having those robust conversations that, like you said, on Friday, I was out shopping for a $250,000 house with a buyer. We
Mhm.
wrote an offer, it got accepted. Monday, we call to get submit the purchase contract, which is what an agent does, sends it over to the lender of the buyer. The buyers and the loan officer do the loan estimate. And what the loan estimate looked like last week is not the same loan estimate as we have today. Plus, the other thing that happened is finally the mill rates came out in the Anchorage area. So now taxes are now all being recalculated because they did a significant increase in taxes
Yep,
in Anchorage. So not only do we get the hit with the interest rates, but we also got hit with the property taxes. And the problem that I think most, when I first started in real estate, the way that I started in real estate, we were at 8%.
uh-huh,
I would, and I wasn't using you at the time because I wasn't living in Alaska. I started selling real estate in Tucson, Arizona. So Karen Fisher, who is still, I think, with Nova Home Loans, was my preferred lender. We had this type of relationship.
uh-huh,
He and I would talk about how much does the buyer need to get into this property? That would be the down payment. And what is the monthly payment going to be?
right,
And the thing that we have to remember in this industry is that when rates went from 3.5%, 4% to 6%, that changes a buyer's significant monthly investment. And for sometimes you guys can't qualify them anymore because of the debt to income ratio. They
exactly,
can't buy that $250,000 house because we don't want to ever do that again where we're putting people in properties where they're having to eat top ramen and toast for the next 5 years because
right,
they can't do anything else.
right,
So I think if you're currently looking for a mortgage loan officer, I would highly recommend at the end of the show, the slides are there for Rhonda Johnson, reaching out to Rhonda Johnson and talking to her about what these options are. What I'm doing right now when we're getting offers on any listing, I call and I'm asking the lender, will this buyer still be able to qualify if rates go to 8%? I
uh-huh,
had one lender say to me, you're crazy. I said, well, did you ever think they'd get to 6.5 overnight? So
right,
I just want to know that this buyer is still going to be able to qualify.
right. And last week we talked about perhaps buying the interest rate down. We looked at those
Yes.
charts. And next conversation, you know, when we talked last week, it was going to cost, a few $1,000s to buy
Mhm.
it down, a little tiny bit. But we have another possibility that we could look at where we do kind of a temporary buy down. And for those homeowners that are maybe first time homeowners, maybe are kind of easing their way into these higher home payments versus what they're paying in rent, then we have a little way to help them ease into what that mortgage payment's going to be over the next couple 2-3 years. And so we'll talk about that strategy next time as well.
Okay, perfect.
Yes.
So if you guys have any questions and you would like us to talk about something specific that's concerning you, just put it in the comments here on our YouTube channel. You can follow me on all social media sites at Melissa Harmel Realtor. And Rhonda and I do shows every week. Please like, comment, and actually follow our page on YouTube. And Rhonda, I'll see you next week.
All right. See you next week, Melissa.